We've had a really wonderful start to this, our second global conference on corporate governance. The talk is all about the resurrection of entrepreneurship and entrepreneurship's role in ESG. And so our discussion this morning is really leading directly into what I know would be a really wonderful presentation from Dr. Charles Ehrhart. We really appreciate Charles joining us all the way from New Zealand, where he has had to have a very early morning wake up to be able to join us. It's 5:30 his time now. So we in the Caribbean here can be truly appreciative that, you know, while we've been enjoying some good sunshine, he has had to make an early crawl out of his bed to join us here. So this session is going to be moderated by someone who is also very familiar to us at CCGI. She is Carmel Haynes. Carmel is the Executive Director of the Barbados International Business Association, where she's been doing a really great job. And Carmel, we've been celebrating with Barbados all morning on its new status of the Republic of Barbados. So we mentioned that again as we welcome you, and I hand over this session to you on ESG and the future of business, looking at it specifically from a New Zealand perspective. Carmel?
Thank you so much, Kamla. It has been a really exciting past few days. I'm also very pleased to be here and joining this session. ESG is becoming something of particular interest for me, coming from my background in civil society and not-for-profits. So I'm very pleased to be moderating this section and also to be welcoming Dr. Ehrhart. Just by way of introduction, Dr. Ehrhart has more than 20 years of professional experience working within governments, the UN, civil society, and the private sector for sustainable development and an end to poverty in our world of plenty. For the past 12 years, Charles has focused on the challenges of mitigating and adapting to climate change. He currently works for KPMG New Zealand as a Director for Sustainable Value. His primary interests are adaptation to climate change, sustainable land use, the transformative potential of environmental entrepreneurship, the role of green economic growth in nationally determined contributions to mitigate climate change, or INDCs, and public-private partnerships for climate action. Charles has a PhD in social anthropology from Cambridge University, and he continues to publish, is often invited to speak at important conferences, and has been cited by major newspapers as an expert on the impacts and implications of climate change. So welcome very much, Charles, virtually to the Caribbean, and over to you.
Thank you very much. Look, it's a real pleasure to be speaking with you all, and I think that a little bit of what that introduction means in real life is that we're approached on a day-to-day basis by clients that are leaning into these challenges of trying to address not only broad stakeholder demands of climate change, but internal stakeholders as well, of trying to understand what's expected of them, what the opportunities are, and concretely figure out what to do about it all, right? So what I'm going to be doing this morning is speaking about sharing a New Zealand perspective on what is happening in our world as businesses lean into these global challenges around the environment and social change, and hopefully be able to draw, especially through the conversation that follows, from that New Zealand example into broader implications for hopefully everyone on this call today. So looking forward to that. So look, I think that the starting point from my perspective, where we are in this incredibly fast-moving space globally, as expressed in New Zealand, is that here at the very least, business profitability and purpose are absolutely bound together, both in principle, in other words, in what people are saying, but also in the real world practice. And we're seeing that come through in so very many different ways, which we will explore shortly. But look, before we do that, I thought it would be really helpful to, in fact, look at some of these key terms. We hear this acronym SOUP, bandied about whenever we get into these conversations around ESG. And there's, I think, still a lot of imprecision, a lot of confusion, lack of clarity amongst key market participants about what it all means, and crucially, how do these terms fit together? Whether we're talking about ESG, TCFD, SDGs, all of this, what does it all mean? What's the difference? So I find that a way to think about it is that these are not replaceable terms. They are not repeating terms. These are nesting terms. So sustainability is the biggest picture, right? That's the top layer. And the most frequently quoted definition of sustainability comes from the UN World Commission on Environment and Development, that sustainable development is development that meets the needs of the present without compromising the ability of future generations to meet their own needs. So in other words, it's about development where we're doing well by ourselves in such a way that we're not robbing from future generations. Now, ESG is not the same as sustainability. So the challenge here is that many organizations find it difficult to get their arms around such a broad concept as sustainability, and such a big challenge as the UN Sustainable Development Goals. So most have a vague idea of what they need to do, but they struggle to measure and report on performance, so key aspects of any good business. So how do they embed environmental, social, and good governance considerations across their strategy and operations? Well, that's what ESG is in principle about. It's that embedding throughout their strategy and operations, and doing that through, well, what we know are key mechanisms and levers in business, which is metrics, targets, this kind of thing. And that's what ESG is about. So environmental component, well, the environmental dimensions cover what most people think of when they hear the term sustainability. It's concerned with improving the environmental performance of an organization, such as reducing carbon emissions, increasing resource efficiency, reducing waste, complying with environmental regulations, these kinds of things. The social component or dimension addresses an organization's impact on employees, on customers, and the communities in which they all live. This can include things such as workplace safety, employee management, diversity and inclusion, both within management, within the board, but more broadly within an organization as well. It also includes customer satisfaction and even data privacy. The governance element is focused on business leadership and structure, including issues like how much executives get paid, who's on the board, whether shareholders get a vote on important issues, and even how a company conducts audits and prevents bribery and corruption. Since the concept of sustainability was introduced into the financial sector, a new type of risk has been emerging: sustainability risks, also referred to those, that's the ESG risks. Now, as we are moving forward though in this, there is another element that is increasingly being discussed, and that is one step further. ESG has a heavy risk leaning, so it's frequently oriented towards how do we identify and manage risks. But there is a growing trend as well, where you've got new entrepreneurs, new market participants, old market participants with a new lens as well, which are asking not just how can our business activities reduce negative impacts and reduce risks that are associated with those, but how can we actually have a positive impact on the environment or society, and in so doing, perhaps capture emerging business opportunities. So ESG is a subset or an approach to addressing broader sustainability challenges. Impact is one step further than that ESG focus, which is typically oriented towards risk. Impact is about having a positive effect on the environment or society. So as we lean into and think about these big developing the principles, the practice of ESG, where is this all coming from? Well, there's a broad range of drivers, everything from the fundamentals of science, which have, I think, been so front and center in across the newspapers with the recent conference of parties on the UN climate change negotiations, talking about what is the science telling us in terms of the climate crisis, to what we're seeing about planetary boundaries and how in so very many ways, by so many different counts, we're exceeding planetary boundaries. And we know that some 50% of global GDP depends on high functioning ecosystems. So some $41 trillion at stake. And meanwhile, some 1 in 5 countries are at risk of ecosystem collapse. So the science in and of itself is a powerful driver behind this. But in our experience, while that is getting businesses' attention and they realize that the science tells them that there needs to be action, what's triggering action now isn't so much the science as it's changing consumer preferences, right? As we see the rise of the ethical consumer, consumers that are clearly preferring environmental goods and services that are coming from ethical providers. And I'll touch upon that more, as we're also seeing that not just coming through retail preferences, but in particular that B2B, business to business lens. Another key driver is regulatory and legal. New Zealand has the distinction of being the first country in the world to make climate-related risk disclosures mandatory. We now have that legislation in place, and that will need to be actually delivered in FY23 for businesses in New Zealand. But of course, that's just one. And we have in the UK, we have in Australia and in other jurisdictions, legislation around human rights and modern slavery. We also have employee engagement. So as we go through collectively this COVID-19 experience, we're seeing great waves of a great resignation. That question of how do we retain and maintain top tier talent has never been more important. And we know, particularly with younger generations, one of the keys to being able to do that successfully is to have purpose front and center in your business model. People want to be proud of the organization that they are working for. And then, of course, aside from all of that, you've got the increasing clear economic imperative, which is around, it expresses itself in so very many different ways. Rising cost of doing business if you are a polluter, through legislation, through legal risks, through access to capital markets, green halos, green bounce in stock markets, all of these different economic imperatives. So this is a brief touch upon the drivers behind this interest in ESG. But let's look at what that means in practice. So where are these, how does this articulate actual businesses? So there are at least 3 different angles that we can think of. One being around opportunities to enhance corporate growth. So this is about how we can grow businesses through capturing opportunities to decarbonize, reflect where the market is going, what consumers, what other businesses want. We've also got another lens that ESG, doing this well, can reduce risks, and then finally boost operating margins, and touched upon that in just a few moments ago, where authentic actors on ESG are seeing green halos, so a bounce in stock market values as they release improved ESG performance, as they release new strategies, bring new products to market, etc. So if those are some of the different angles through which the rhetoric of ESG and practice actually hit the bottom line, let's look at what businesses are actually doing on the ground. And I think a way of approaching this in the real world can be to think about what businesses are doing to protect value by addressing ESG issues and what they're doing to create value. So thinking on that side of value protection, well, again, that gets us right back to how you integrate environmental, social, and good governance concerns into your day-to-day decisions, and then also, though, into your core business strategy. So how do you reorient your business strategy, move away from those business models that rely on high pollution or through a number of those different ESG lenses, put your business at risk. Value needs to be protected as well by, once you identify what those risks are, actively monitoring them and making sure that you're doing the right thing, and then ultimately communicating what you're doing to market participants. Okay. On the side of value creation, what we're seeing is businesses that are being able to leverage the power of their positive ESG story, which is backed up by real metrics and real evidence. And they're being able to take that performance and that evidence to market to raise capital. And as in many parts of the world, in New Zealand, we are seeing the great growth of green bonds and sustainability-linked loans. And I'm really hoping in our conversation later today, we can touch upon the issue of sustainability-linked loans, many of which at present have a very thin veneer and thin evidence that this represents a real divergence from BAU. But we are already within a year of this moving it through our market. We're seeing increasingly critical coverage of what's under the hood of those sustainability-linked loans, and we're seeing expectations begin to tighten. So we'll see, we'll explore that hopefully a bit more during our conversation. We're seeing businesses that are actively diverting in their financial planning processes capital from higher risk ESG activities into opportunities, new goods, new services with potential for high returns. And then finally, with value realization, we're seeing improved ESG performance being converted into reduced cost of capital. We're seeing it converted into market preferences. So if that's what we're seeing on the side of businesses, and we've already touched several times on how this is being seen by market participants, investors, institutional and retail, let's take a little bit about take a little bit of a look about what that means in practice. And we're seeing this through lenses of and discussions of responsible investing. So if we start off at one end of the spectrum with traditional investors that have either very limited or no focus whatsoever on ESG factors. So that was kind of the old BAU. And then what we've seen is from there a growth of fund managers, retail investors that at the very least are interested in taking a negative filtering angle, if you will. And what they're doing is saying, well, we know that some activities expose a business to potential particular risks, right? Whether it's participation in selling alcohol or any number of negative screens, right? And they're saying, well, we want to filter those kinds of businesses out of our portfolio. So just focusing on the negative and a negative screen. Well, then that can shift into a positive filter in which you're saying, well, yes, I want to exclude businesses with negative ESG impact, but what about those businesses that are actually doing well in ESG? So there's a little bit, you can start moving into that positive filter, looking at businesses that are demonstrating that they are leaning into the challenge of addressing these big historic environmental and social challenges and incorporating that into their core business model. And so then, though, you've got a next step that is actually looking for businesses that are having a positive impact. So they are capturing some of this market momentum, the need for solutions, and these are the businesses that are bringing new goods, new services to market that are actually helping solve some of these challenges. Now, all of these kinds of strategies by asset managers or even retail investors, these are all still within the realm of competitive returns. And one of the things that we're seeing is that, that there is evidence that that ESG strategy, robust ESG strategy by investors can deliver above market returns, even over the relatively short term, even beyond the long-term argument. And then, of course, at the far end of the spectrum, you've got philanthropical investment. These are investors that are not so much concerned about financial returns as they are seeking positive social and environmental impact from their money. But even those impact investors, though, they're still looking for commercial returns. They may be prepared to accept lower rate of return for a higher environmental or social impact, but they're still seeking competitive returns. And then you've still got even that larger area of the market that at the very least has a negative screen, or ideally a positive screen, where they are seeking businesses that are showing that they are leaning into in a mature, substantive way to the ESG challenge. So look, the truth of the matter is that we've got an awful long way to go within those, amongst those market participants. ESG is being treated in a very immature way by many asset managers, in the sense that they've got a big learning curve ahead of them. That said, we are seeing we're seeing growing maturity. We are seeing asset managers that are coming up with increasingly sophisticated ways for cutting through the greenwashing, to really get at, to understand whether a business really gets the challenges and is really strategically seeking opportunities. You know, we were approached by a client here in New Zealand that shared with us a fascinating story, explaining that they had been approached by a PR firm that had said, look, you don't really need to do real changes to your business. We know what words to insert into your annual report with what frequency that'll get picked up by these big scans, and we'll give you a positive ESG rating. You don't actually have to do anything, right? So that is out there, but good asset managers are beginning to see through that and get strategies. To me, and one of our main message with clients is that this is all about the power of and. I really value that, that idea. This isn't about ESG or profitability. This is about profitability and responsible ESG. It's about prioritizing purpose and profit. It's not about stakeholders or shareholders. It's about addressing both and understanding that ultimately shareholders lose out if we don't address those broader stakeholder concerns. It's about recognizing that staff are people too, and that they bring their whole self. People want to work for a business with principles. It's about understanding that at the end of the day, our businesses are embedded in society and in the markets, that businesses will only be able to survive, markets will only thrive if they're doing so within the context of a thriving society. Ultimately, it's a matter of being able to integrate and work with business and ethics into a holistic systems-based model. Well, so there's the theory of it all, but in practice, we're seeing some really dangerous disjunctions, right? And I think that nowhere is this more clear than with regards to climate change. In a recent poll in the United States of business leaders, the question was asked, well, do you see climate change as posing material risk to your business? 81% of respondents replied that, yes, we do see it as a material risk. So we recognize that this is a real threat to our businesses. But then when it came down to the question, do you actually have confidence that you understand the nature of the risks that climate change poses to your business? Only 29% said that they actually understand what those risks look like, right? And then even fewer had actually built out a strategy or felt that they knew how they were going to address these risks as a business. So 81% saying that we know that this is a problem to our business, but only 26% feel that they had done something about it. And to me, what was fascinating about this, peering into those numbers even more deeply, that 26%, most of those were only embedding climate risks into their operating models. So they still hadn't really integrated climate risks into their core business strategies, right? So really, it's a clear risk that's emerging at the business level. But as I understand, we've got many people joining us today that are directors of businesses. There's another angle here, which is the direct challenge that this presents to businesses. Now, in the New Zealand context, as well as in a number of other countries, it's clear that this poses direct personal risks to directors. There are more than 1,300 climate-related legal cases that have been filed around the world. Here in New Zealand, we've got about 17. And that number is growing. Recently, in the case in Australia, we have a case where a young person filed a suit against the manager of their superannuation fund, saying that you are not taking climate risks into account, and therefore you're doing me a disservice as the manager of my superannuation fund. And that did not go to court because the super fund acknowledged the point. Yeah. So directors are on the hook here. The cases are moving forward. And we're also seeing this translate through into insurance companies that are increasing premiums because they realize that directors are at growing risk across a broad range of ESG issues, but I think most poignantly and most topically, climate change. Well, look, all of these concerns are what we're seeing drive an increased demand and expectations around the world for clear disclosure of climate-related risks. And the banner for this has become the work done by the Task Force on Climate-Related Financial Disclosure. And I think that most people on this in this conversation today will have heard of TCFD. It's got 4 core areas, being governance, strategy, risk management, and metrics and targets, with 11 themes, key criteria underneath that. We're frequently asked in KPMG, what do we think about the TCFD recommended framework? And our response was, well, it's fine. How can you argue with it? Because at this point, it's not very detailed. It's not very granular. And in terms of those broad areas and broad criteria for what good disclosure needs to include, well, of course, those things are all important. But what we're now seeing is the emergence of more granular reporting expectations. We're seeing this with a global initiative, which was recently announced, which I think is going to be very significant. But in the case of New Zealand, we recently had an act that I referenced a few moments ago, which is requiring climate-related disclosure. And we're having the development of our first climate disclosure standards. We've already had a discussion document come out for what those standards will look like around governance and risk management. And we'll soon be coming out with further guidance or a discussion document about what those standards may entail around strategy and metrics and targets. The really good news here is that while New Zealand was the first country to make climate risk disclosure mandatory, and many others are clearly going to be following, including in the UK. Governments are cognizant of the burden that, or the challenge, I should say, that multiple legislation or multiple jurisdictions may place on businesses. So they're trying to make sure that their requirements are complementary to each other rather than wildly different. So in the case of New Zealand, we're using the same principles, the same broad areas, and 11 criteria of TCFD are all incorporated in our disclosure, our emerging disclosure standards. It's just that they are more granular, and all of the components of our draft disclosure standards here are lining up with existing climate disclosure standards, sustainability standards that are already out there in the market. No big surprises, and I would anticipate this to be what we are likely to see in other jurisdictions, that we're not seeing anything that's particularly surprising. We're going to see complementarity between different frameworks, different jurisdictions. So from our perspective, this complementarity between different jurisdictions is going to be very positive. It's going to address those concerns that climate-related information, as an expression of ESG risks, that you're getting greater expectations of what robust disclosure looks like and coherent. So from a director's point of view, though, this should actually be welcomed. I know that many of the directors that we are working with are finding it a struggle right now because they don't necessarily know what good looks like. They don't have all of the information. It is honestly a stress point, but that's just because we're in such early days. But ultimately, this represents a good thing for directors. This represents a very concrete way for directors to be able to fulfill their duty to exercise reasonable care and diligence. And it also provides them with an opportunity to demonstrate the skill in doing their jobs. Yeah. Now, from our point of view, there's been a lot of focus in New Zealand's market, certainly because market participants are just struggling to understand what the mandatory element of climate disclosure looks like. And so there's a lot of talk about that. But I think even here within months, the conversation is progressing to recognize that while we do need to deal with the compliance element of this, ultimately, this is not about compliance, ticking the box of a climate disclosure. Ultimately, this is about doing the right thing for our businesses, making sure that they are going to be resilient to the impacts, physical and transition risks of climate change. The real value here of the mandatory reporting to us is clearly that it is a catalyst, a trigger for getting critical discussions going at the right level within businesses. So the disclosure component, it's getting things, it's making the discussions happen at the board and management level now, rather than at some point in the future. And amongst other things, businesses are recognizing that what they really need is to have a coherent, comprehensive strategy and plan for effective as well as cost-efficient way forward to address climate change-related risks and opportunities. I'd like to bring this to a little bit of a close, though we could continue for quite some time. I want to share with you kind of 4 big points that we're looking at that I think are broadly significant around the world with ESG. And then we'll open up to our broader conversation. The first point for consideration is that, well, ESG doesn't grow on trees. Products, services, and company valuations that reflect the cost of doing ESG business. At least right now, in many cases, there is a cost here, which is either being absorbed by the business one way or another, or passed on to the consumer. However, despite being more costly, there will be a market for high ESG related products due to their ESG edge. So the truth is that this is initially an additional cost for businesses, but that shouldn't be lost in the overarching benefits, financial as well as other forms that come back to businesses. The second is that point that I had raised about the risks of ESG, both blacklisting of companies, so consumers and other businesses saying that we don't want to work with a particular business because of how they are negatively perceived. And then there's also the personal dimension here for directors. Certainly one of the things that we're seeing moving through the New Zealand market is this third point of cascading expectations across value chains. Governments and large businesses understand the value, the power of their purchasing. And as they, as part of their own ESG strategies, move towards ethical or sustainable procurement policies, what they're doing is pushing their supply chain and value chain partners to move forward as well. We're seeing this very, very crisply in New Zealand, as we're seeing many of our larger businesses that are putting in place really high expectations around sustainable procurement. It's been a really shocking wake-up call to smaller providers that are saying, wow, we really need to move on this, and we need to do so now. And then the last thing is just a recognition of ESG cowboys. As the lucrative nature of successful sustainable business models becomes apparent, it's obvious that we are also having bad actors out there, ESG cowboys that are moving around in this wild ESG West that are misrepresenting what's really happening under the hood of businesses, doing a poor job. They're taking advantage of the language and broad interest in ESG to make a quick buck, and obviously this is disconcerting, has implications for the viability of our economic system as a whole. But I think one of the things that we're seeing is a broad recognition that we're just not doing well enough, that we need to figure out how we can get filter those bad actors and bad actions, inauthentic ESG out of the market. The challenge really is about how do you do that in a robust way at speed and scale. Thank you.
Well, thank you too, Charles, for a very enlightening presentation, really taking us through how people are capitalizing on this next big trend and not necessarily bringing value. So that's something we should watch out for. And so I would like to now invite our panelists to be able to engage further on this topic. First up, we have Antonia Ferrier. And she is, if you ask her, she'll say she helps people make growth decisions, and she has the results to prove it. Through her company, Definitive Management Solutions, she uses talents as a strategy consultant and performance coach to support the growth and development of both companies and people using neuroscience-based approaches. And her background is in social science, business psychology, and she's also a certified emotional intelligence consultant. And so you can read more of Antonia's bio in the program. Also joining her in this discussion are Peter Aylwin, and Peter is an entrepreneur, investor, and family office director with over 20 years international experience, gained from an initial bedrock of finance, research, and investment. He's lived on 5 continents, including the UK and several European nations, the Middle East, India, Asia, the US, America, Africa, Australasia, and Australia. So there's a little bit of a geographic connection there, Charles. And again, you can read more of Aylwin's bio in the program. So I would like to now invite the two panelists to spend about 5 minutes each giving their thoughts on this topic. So Antonia, I'd start with you.
Thank you. I want to jump off from the point around the climate change and embedding the ability to create business opportunities and investments into business strategy. Climate change is something that is always at the top of the mind in the Caribbean. But the interesting thing is we tend to think about it in terms of the big impacts that we see, which is we know about the conversation around rising tides, and we know about hurricanes and earthquakes. And we talk about that because we know where the felt impact is. Many Caribbean islands depend on the tourism, and so the destruction of the seafronts that comes with it is what gets the attention. And so the conversation has been in terms of managing climate change, when you link it back to the SDG conversation, has focused on reducing energy consumption and reducing emissions. The interesting thing though, when you look at the statistics in the Caribbean, and you can always pull up the CARICOM, the recently released CARICOM statistics for 2020 that was put out by the CARICOM Secretariat. If you look in the last 20 years, even as we have the conversation about reducing energy consumption and reducing emissions, in no instance do you see this is actually happening. It's actually rising. And so you would think that if we are so affected by it, that we'd be working hardest by it. And you can make the excuse to say, well, really the impacts are coming from the large consumers outside of the Caribbean. And so it puts us, you feel like you're powerless, but you have to look below the top level statistics. And the reality is that underlying the SDGs and this whole conversation about shifting where the value is from profits in the business to people, society, good governance, is coming from a recognition that there is need to improve the living, the standards of living and the conditions, yes? And it is that desire to improve living standards and quality of life that is driving increased consumption. Electrification is very important. Good transportation networks, both of which requires us to consume more fossil fuels, removal, deforest the islands, yes? And so there is an inherent conflict in us in solving that problem. And so from a business perspective now, strategy, where do we sit? I think the solution lies in three concepts. One is recognizing that everybody has to contribute in some way. And everybody, whether you look at it at the interest at the public level, at the private level, or personal interest, everybody sits within one big environment called the ecosystem. And so emergent strategies, and there's a whole model now called emergent strategy, which looks at the first rule, small is good, small is all, is that the large reflects the small. It's a new thought process in how you develop strategy. We are custom top down, we start with the big concepts. But if you look at how nature itself works, the big is really made up of very small things all coming together, creating this big effect. And so we are seeing a shift now to think, if you look at the Caribbean, small islands, that has always been our problem. The scale, a lot of the solutions that exist don't fit because we don't have the scale. What can we do as small actors working collectively, but around the same topic, to move us towards creating the kinds of change that we want to see? We need to have a shift in thinking, and we need to start thinking laterally, because when we talk this conversation about climate change and investments, we keep thinking we don't get into the investment side. We think about risk management, recovery. But if we do some lateral thinking in that disaster, there is opportunity. Yes. And so that's where the investments lie. And so we have the small is all working, where we see in Barbados, for example, they've taken the disaster that was the inflow of sargassum weed, which we see as rubbish and destroying the tourism sector. Small is all came along and said, hey, inside of that weed is actually seaweed. We have agar, we have iodine, we have fertilizer, and they are commercializing what is now a free resource that's coming to them because of the climate change and finding commercial opportunities out of it, you know? And so it requires a level of, as I said, lateral thinking. And I think organizations looking to capitalize on this to find the investment opportunity, because that is what they, you know, primarily what you exist for. There is a remit, is to find that, encourage that small is all. And so while we talk about license to operate, I think we need to shift the license to innovate. We need to, from a governance position, free the framework so that people are not just comfortable in believing that they can think, but confidence in believing that that thinking will translate into material outputs. Innovation is really, a lot of people don't agree with my definition, but innovation is creativity funded. And that is where we lose all this creative talent and the engagement of staff, because they have the ideas, but the organization is not willing to fund those ideas to translate it. I get approached all the time by students with these great ideas in university, but they can't get the professor to take them on. And so we put all this money into research into the university, but the people with the ideas, because of the infrastructure of grants and whatnot, are locked out of it. And so what I would like to encourage is for us to create an environment of affirmative action that is supportive towards finding the small of and is all, and changing that small is good into small is great, and finding a way to bridge the thinking and the funding in a way that will help us unlock the challenge that is climate change. That's all. I will end right there.
Thank you so much, Antonia, for sharing your thoughts with us. Oh, sorry. There's my camera. I would like to now invite Aylwin to also share his perspective on this topic.
Thank you kindly, Carmel. Well, the reason why I was kindly invited to this conference is after our many dialogues by Professor Garrett and CCGI on the greatest wealth transfer in history, which for some of you that are not aware, just in the US alone, there'll be 68 trillion transferred from one generation to another generation of inheritors in the USA alone by 2060. And in the coming years, there'll be 30 trillion globally. And there's many, many more studies on these niche areas. But at the apex of this phenomenon are the family offices and the ultra high net worth community. Ultra high net worth individuals possess a net worth of $30 million US or more, and family offices are generally loosely defined, and there's a few criterias. But I like to go with the definition of $100 million US or more in investable assets. Now, what is possibly missing from the conversation from a lot of these institutional and governmental and governance discussions is the enormity of this sector. Because when you look at just ultra high net worth individuals and family offices alone, they far exceed most other investment categories, particularly alternative investment categories, such as hedge funds, private equity, VC, etc. And then now, to a certain degree, there's somewhat of a competition, particularly for smaller and mid-stage investments. So with that answers some of the question on the what will make a lot of these ESG sustainability and social impact projects financially viable and have that balancing act. And the key thing, of course, is with the next generation. They think very, very differently to the patriarchal generation. they're already sold on impact and ESG, many of them. They're more creative in their outlook, very entrepreneurial and highly tech savvy. So they're in tune with this movement towards digitization and, of course, entrepreneurship tied to that. Number one. And number two, we're unequivocally moving into the era of the virtual global citizen. I've been a global citizen, let's just say offline and without tech for probably 1.5+ decades. However, now it's at the fingertips of many, many people through their social media, through their online business media and other mechanisms. But a key component of where this can all go is, from several discussions with Professor Garrett, is I don't just look at E plus ESG, but economic returns plus entrepreneurship plus ESG, because what can solve a lot of the problems in our world today is if they are considered financially viable investments as a social impact or ESG investment, then it's not just a passion investment from an ultra wealthy individual where they believe in the project and they want to do just good. It becomes a critical part of their portfolio where wealth preservation and growth of that wealth is going. And with this, a number of the discussions, of course, in climate, new policies in government that are supporting this, I feel that we are at a very interesting crossroads, that if we structure things from a governance perspective in the right way, we can truly create a very, very large pool of funds to fund a lot of these ESG projects in alignment with these new issues around values. I mean, my vision is why we can't take these seed investors that are ultra high net worth individuals who are initially there. Many of them are, though, in a fragmented industry of family office that don't understand institutionalization, which is obviously Dr. Ehrhart's specialization with governments and institutions. But as they're the critical seed money, if it's well structured and interfaced with government and institutional money, that's where it can become a multi-trillion-dollar industry. Whereas right now, if you just look at the GIN statistics of 715 billion, is where presently they say social impact roughly sits. On a few other points, of course, I think number one, we've got to look at beginning with the end in mind and build that critical path, which is somewhat under construction now. The path is becoming a little clearer, but there's different investment cultures globally and criteria. So in America, they've got a very much of a spirit of the entrepreneur, a belief in the entrepreneur, and they see future value for early and mid-stage investments. So even pre-revenue, they'll invest more money and have a high valuation. But what is unfortunately starving some of these Asian, European, and UK investment and other regions is they don't have that culture. So it's got to be asset-backed, cash flow generated, and also a more stringent criteria. And smart entrepreneurs now, and even financiers, know how to just arbitrage this, where they're taking investments from outside of the US and then doing a fundraise and valuation in the US to actually fund these projects. Whereas if that attitude towards or that mindset were more considered as part of a criteria in Europe and the UK and elsewhere, that may cause greater growth. Of course, and I like the term that Professor Garrett used previously about the new cement in our institutions, focused on, of course, ESG and the conscience of the organization. But now we're at a stage where the cement is still being mixed and still very much wet, and how we construct this is really up to us. A key point not to ignore is and again, I won't give a detailed discussion on family offices and the size, but 85% of founders in Asia, in the family office segment, are still the first generation or business owners in that segment, which is huge. Why is that? It's because they're not professional money managers yet. They're still not as sophisticated as some of the West, and the whole family office concept is fairly new. And so as a result of that as well, you've noticed that statistically, they're actually higher in sustainability. There's about 40% are already investing in sustainable investments, whereas they're still in the 30s as far as a global phenomenon. So they've got that entrepreneurial sort of focus. And looking at the conversion to ESG in order to obtain economic returns. I'll give an example. Business colleagues of mine heavily focused on oil and gas, for example, and that's still a profit center for them, but they've noticed what the market trends are and have been heavily investing in areas such as alternative energy and solar. And with the new policies coming into place, it's becoming a much greater percentage of their private equity and institutional level allocations. Also, as well, you look at mining. Just literally yesterday, I was in discussions with a mining-centric association representing different commodities, and unequivocally, they've got a clear and specific criteria for their main members to follow on the areas of social impact and ESG. Regarding the 4 final points on important trends in New Zealand business, number 1, saying better is no longer good enough. Well, of course, now we're in that situation of now we know what good enough is and what even maybe excellent and great could be. And as those definitions become clearer, we have much more to aim for. Demand for alignment, standardization, rigor, and transparency is growing. Well, yes, the definition amongst, again, this ultra high net worth community on transparency is gaining greater sort of understanding and traction, where they actually do consult with specialists in ESG now. It's not coming just from the heart and from the passion, but they're thinking, how can I invest with some of this critical percentage of our wealth that is actually part of our long-term preservation, not that small little pool that is a passion or philanthropic sort of allocation. Expectations cascading through supply chains. Well, those supply chains now, and what that means, what I use the term critical path, they're being defined. But again, digitization and the digital economy is playing a huge role in that construction. And intra-industry collaboration is growing. Well, in the ultra high net worth and family office community, there's a big trend towards direct investments and co-investments. Where the gap is, again, is where the private wealth has an understanding of what it takes to gain institutional level funding or governmental traction and removing that red tape. That's where a big part of my focus is, because I've got a foot in sort of all camps, but I'm sort of more known on the family office front simply because it's the most fragmented industry and there's least understanding. So look, to tie it all up, to address the area of, I know greenwashing was a point Kamala brought up in the other discussion, is of course, family offices are not all sophisticated as investors, number 1, which is a key area. So they are an easier target for some fund managers that are money managers. Also, larger projects, for example, some of them are, if they're a direct investment and not through a fund structure, sometimes that's more appealing because the parties want to feel they're collaborating in a partnership, not just parking money in a fund and then they have no say in what's happening. Again, we're in the era of the virtual global citizen. Governance of ESG impact of sustainability is now being galvanized, and that economic returns plus entrepreneurship plus ESG model is now getting a chance to sort of form. And of course, in closing, for example, it's not just about having a greenwashing label. There are parties that are still vulnerable to in the investment community to these areas, but I really feel that where we are going, and based upon our actions as governance leaders, Dr. Ehrhart's position with thorough understanding in terms of governmental and institutional, where there is basically a real economy demand for impact, sustainability, and ESG. And it's about intertwining it so all voices are really heard under the 3 C's that I like to use: collaboration, co-creation, and of course, co-elevation of one another's interests. Thank you very much.
Thank you too, Aylwin. And so now I'd like to open the floor up to any questions. I'm not seeing any in the chat, but please feel free to raise your hands if you have any questions, or if any of the either of the other 2 panelists have, either of the panelists have questions directly for Charles or vice versa.
So we'll just remind our participants that they can, in fact, either raise their hand, their virtual hand, or they can place a question or comment on the chat. But I really thought that this really has been a brilliant session so far. And there is a question in the chat. Carmel, I'll let you have it.
Yes, I see that. Thanks, Kamla. So thanks, Camille, for asking of Charles. Considering the reward and penalty motivators for adopting the impact perspective of ESG, what efforts have been made to quantify the penalty motivators for ESG and use it as a focal point for directors who prefer to hold to the traditional investor type focus?
So that's a good question, and to me, a way of approaching this is that there's broadly a challenge of how do we quantify a lot of these ESG risks and or opportunities, and globally that's a challenge. In a country like New Zealand, which I really appreciated listening to Antonia and reflecting on some of the parallels that I think exist between New Zealand and Caribbean being another small island country. Look, globally, there's a challenge with how do we, is there enough data to really be able to quantify environmental, social risks or opportunities, negative or positive impacts? And here we just, it's a particularly acute problem. That said, that is not a crucial inhibitor, because it is still possible to have a qualitative assessment of ESG risks and opportunities that is still compelling on its own merits. There are limits to how far that qualitative assessment can go. For example, when you're looking at these asset managers that are scrutinizing vast numbers of businesses at a time, that qualitative in-depth view is very difficult for them to articulate with. But certainly from a perspective of directors, that qualitative insights into their ESG risks and opportunities for their businesses, that's not very difficult for them to do. And you've also got an issue, I think, there around what I've heard referred to as optimal ignorance, which is to say that, look, for example, if I'm in the agriculture sector, I don't need to know exactly how many millimeters rainfall has declined or what the 30-year average is. What I need to understand is whether rainfall patterns are shifting enough to create a material challenge to my business model. Right? Rainfall happening out of season more than it had been in the past, acute weather events. That's enough for me to know, to act and recognize that I need to think about my core business model.
Thank you very much, Charles, for responding. Sorry, I'd first, before I go on to the other questions, like to apologize to Peter. Peter, when I read your bio, because it had an Aylwin in the text, I was reading that as your first name, so apologies again. So Peter or Antonia, do you have any questions for Charles?
Actually,
I certainly do, Dr. Ehrhart. In particular, you understand from a couple of the points I made about that very fragmented but huge pool of capital, some more sophisticated than others from the ultra high net worth and family office community. Again, let's call some of the social impact passion focus. So there's a mindset of philanthropy is giving it away, impact investing, but there is a bit of a hybrid I came across in developing markets, having lived in them. For example, they would often invest in businesses that would give free food, free treatment, or free services to the underprivileged. But those that could pay, or in the corporate markets, etc., they charge them. And so you've got a social impact investment where it's actually making money, but they're also giving away and providing that service for free. And it's about the long-term sustainability, whereas you get some philanthropic model where, let's just say you have two identical twins, one inherits 100 million from their father and mother, another inherits the same. You have one that's a purely philanthropic entity, and the other one's doing 50%, or so say 80% of the capital is socially impact invested, and the 20% is philanthropically invested, with the returns of those impact investments, a portion of them going back into philanthropy and others being reinvested. I'm just looking at the long-term viability of those structures, because we've got a huge, if the 501c3 model in America is a huge vehicle for a lot of the American investors, we've got a governmental. Have you looked at any structures, number one, that are of course seed investing from either through philanthropy or impact from the private wealth world that could help the government and institutional level? And two, my other contention, which is part two, is how do we grow this in your opinion? I just like to put this number of 5 trillion in bonds and debt, and sort of a debt model, and say 5 trillion in capital, and that can be from private capital, private equity, and of course listed equities. I mean, those 2 areas. I'd love your thoughts on what could be missing from this collaboration between private wealth, institutional, and government that you think needs attention.
It's a good question. It's an interesting question. I think that I think that I think, Peter, from the sounds of it, both of us are interested in system change and trying to figure out how that can be brought about. And in your case, clearly you've got a passion for how private wealth and the role that private wealth and home offices can play in triggering transformation or enabling transformation. I have not heard about, and I've worked with a number of home offices in the past and high net worth individuals. I have not heard of governments specifically setting out to engage with that, if you will, segment of market participants. Certainly what I have seen and am very interested in are some of these hybrid investment models where government is trying to channel resources towards innovation that has the potential to address some of these big social and environmental challenges. Hybrid investment models where government may be kind of the first in, last out kind of an approach, trying to, through government investment, encourage other investors to move into a space. I have only seen that really expressed in terms of broad market encouragement. I haven't really seen that targeting the home offices and high net worth individual participants. That said, I do think it's interesting. I think it's been, there have been some very high profile cases of high net worth individuals, home offices moving into a space, trying to really accelerate innovation with positive social and environmental impacts. I think that despite those high-profile examples, I don't have the impression, certainly not in a New Zealand context, that that's been a particular focus.
Yeah, it definitely is happening now. A lot of the universities are acknowledging it, and again, the myth is it's not all of these high-profile Fortune Forbes billionaires that are famous. They want to be seen and as either a philanthropist or an impact investor. But a lot of those private individuals that have had an exit, they're operators by nature, not necessarily professional investors, and they've just got a family office around them. That's an interesting phenomenon because they may know an area well, have an expertise, but they've never really had to interface with government necessarily, or they've never had to structure an investment proposition to exit to or appeal to an institutional investor. It's still shaped around them as the boss, their vision, etc. But now that they've got all of this sort of money and liquidity to see those early stage investments, some between sort of 1 and 50 million, and that's the high risk, courageous capital. So it seems to be a gap, and that's where I think the opportunity exists for governments for governance practitioners, and of course, world experts such as yourself in impact, ESG, and sustainability.
Much, Peter. There's a question in the chat as well. Right, and I'm not seeing Carmel, but I know, Antonia, you had a question as well. Do you want to ask it? And then we'll go to Carol's question.
You're not seeing me, Kamala?
So let me just see.
I wanted to jump back to the first question around measurement. And, you know, one of the things Dr. Ehrhart had raised that I quite agree with is that ESG and sustainability is not the same. And what we see happening, certainly in Trinidad, is a proliferation of reporting around ESG in the form of, you know, sustainability reports. When you look at the metrics inside of there, they look at compliance. They look at normal traditional metrics of impact in terms of pollution and emissions and whatnot. And I think as a driver of change, that does not encourage investment. It might encourage control and selection of suppliers and that sort of thing, but not drive real investment. I want to ask, in terms of measurement then, something that appealed to me in my own research around sustainable models is that really it comes down to the condition and quality of life. And so for it to be meaningful, it has to be measured in terms of what matters to the people, to the stakeholders, and contextualized within the ecosystem approach to strategy development. We are seeing a shift, certainly away from success, not just as financial profit, but also success in terms of outcomes that the various stakeholders want. To me, if you want to put that in a metric, it has to be a change index. And one metric that appeals to me is the gross national happiness index from Bhutan.
And other countries.
I love that metric. And it comes back to, again, the thing that I was talking about in terms of everybody having a role. Because for us to have a material change in condition, you have to have the environment that enables it. And it drives us back up to public policy. But for some reason, public policy also comes with an expectation of public spend, you know. And going back to Peter's point about the transference of wealth, the spend is actually occurring on the ground, you know. So do you see anybody making a move to link that social need for the quality of life and express that happiness interest, linking up to both public policy and where the funding is being pooled to look at those types of underlying initiatives that will create the kinds of change that really speak to sustainable living and well embedded within a sustainable strategy, both business and public.
Okay, so lots of different angles to take there. Look, gross national happiness, these kinds of conversations, I mean, this is great. Interestingly, New Zealand is one of around 4 countries around the world that have been trying to explore this. We've got a living standards framework, well-being framework that is supposed to guide Treasury decisions for New Zealand. The truth of the matter is, though, that we're still struggling with how to articulate that, how to express that in real decisions. We are gathering metrics around this and data, but how you actually bring that into decision-making, day-to-day decision-making by Treasury, by those with their finger on the pulse for capital remains to be seen. Yeah. So I think that there is growing interest in this. We have some businesses, small businesses, that are being more innovative in this space. but we're not yet really seeing that in terms of larger businesses. And I think that kind of compounding all of this, and you know, we've touched upon the metrics and this distinction between ESG and sustainability a few times, and maybe to make that a little bit more real, or to express what the concern is there. We could have a business that is measuring environmental, social, and good governance. And an example of that would be some of our large retailers here in New Zealand. And we're saying that they're measuring they've got their ESG metrics. Yes. So they are converting out their light bulbs to LEDs, they're reducing their energy consumption. And so their ESG metrics are improving. Yes. Yeah, no doubt about it. But then you've got a fundamental question about their business model and saying, well, actually what you're selling is stuff that is designed to fail. Right? You are selling inexpensive products that by definition have a very, very short lifespan. You know that your business model is fundamentally unsustainable. Yes. And so I think that these are the kinds of big questions like what you're asking that we really need to get to, which is, all right, so if we focus too much on metrics in the small picture, we can lose sight of the larger challenge that's being levied around sustainability, that's embodied in the SDGs, and through that as well, lose sight of the opportunity here. I mean, this system that we've currently got, it's not working for people. Right? You've got huge swaths of the population that are increasingly marginalized and not being able to participate at more and more risk from environmental and social change. We've got this growing disparity between wealthy and poor, and all the social fracturing that you see as a result of that. Metrics are great. Those details are an important part of this, but we can't lose sight of the big picture and what's really at stake, both in terms of risk and opportunity.
Yes, because I really believe that it's not just a metric, but it's what you're measuring with that metric. And I think increasingly that we need to shift to the outcome end and not the input end, you know, and really look at measuring it from the perspective of the people, what would make them happy. And measure the outcomes as that. And I think that would drive where the social spend goes, you know, rather than a philanthropy perspective, which still says, I'm giving you money to do something for you. Shift to saying, I'm investing in your well-being. And that, I think, changes where the focus of the spend and what to get spent on, and who is allowed to spend it or engaged in the spending of it will shift. Yeah.
Okay, thank you both. Just turning back to the chat, and this is a question from Carol. Dr. Ehrhart, are insurance companies including ESG risk in their coverage and pricing their products for them? Alternatively, are they trending towards treating some of these risks as exclusions in their policies?
Yeah, all right. So this is a really interesting question. So we work with a number of insurance providers in New Zealand, and of course, globally, KPMG works with many of them around the world. So yes, they are beginning to bring ESG risks in particular into their business models. You could say for better, for worse, and for worse. So we've got a case where we know that an insurer has given a matter of months. So one of the benefits of insurance companies is that they can shift their business, address risks quite quickly. And so we've got, we know of an insurance provider here that has told a business that is involved in the transport of coal, that next year, as of next year, so few weeks away, really, they will no longer be covered because the transport of coal is not in line with the insurance company's responsible banking and insurance policy, right? So that's interesting. So they've just knocked them out on a negative exclusion. That's interesting because that's there seems to be, while that is interesting and may address a need of the insurance company to reduce risk in its portfolio or reputational risk in its portfolio, you kind of wonder, what about a transition period? What about a period of engaging with businesses that might not be aligned or you may see as a reputational risk, and saying you have X number of years to shift your business model before we stop working with you? So it's a question, right? But so we are already seeing those reputational risks that insurance companies face being translated into real world financial decisions to stop, in this case, obviously insuring a client that would be paying quite a bit for their insurance policy. The other direction that this is going is that, which is disconcerting, is technology is enabling even greater granular risk-adjusted pricing by insurers. And to give you an idea of what that means in practice, it is possible in our island country, for instance, for insurers to have that very fine-tuned geographic data overlaid with climate risk analysis to say those people, those houses that are in higher elevation are at lower flood risk, and therefore we will charge them less for home insurance. And those houses that are down lower elevation, higher risk of flooding, well, we will charge them more. Now, okay, from a business perspective, that makes a lot of sense. But I got to tell you, as somebody who's relatively well off in our society, what that means is that somebody like me who can afford higher insurance premiums has to pay less. And those people in more flood-prone areas that have lower cost housing and can least afford higher insurance premiums, they're the ones who are getting the higher insurance burden. And so what that technology is allowing a company to do is address an environmental risk, right, through technology and change their risk to a risk-based pricing model. But what's happening is that they're doing that at the expense of a reputational cost. Interesting, right? How are businesses going to lean into this? There's a lot of learning to do, but these ESG challenges, ESG issues have some really complex trade-offs that businesses don't have enough experience in. They're going to have to wade into it, and there's going to be a lot of learning to do.
So very interesting indeed, considering that we are a flood-prone region, and also we, have significant impact from other types of disasters. So thank you so much, Dr. Ehrhart, for ventilating these various issues around the ESG for us. Unfortunately, due to time constraints, we are going to have to wrap up this session. So I would just like to ask if there are final thoughts from yourself or the other two panelists. You would have about 2 minutes each. Do you have any final thoughts, Dr. Ehrhart?
Yeah, I think that a concept that we're working with clients on is thinking around the 3 different horizons. And a way of thinking about that with ESG is that the first horizon is where we learn how to do things better, right? So continue with our existing business practices, existing model, but do it in a way that has less environmental, social harm, et cetera. That second horizon or challenge for a business is thinking about, well, what might we want to do differently? So what new products might we want to bring to market or services as the global economy shifts? The third horizon is what might we want to be that's different. And an example of that third horizon is where you see some of these companies that are shifting from being a fossil fuel company, oil and gas company, to rethinking, reimagining what they are as an energy company or an electrons mover company, right? So I think that all three of these horizons or lenses are really valuable for businesses to be thinking about. Certainly, I was listening to a client, and their light bulb moment was saying, you know, we have defined ourselves as a seafood company. We need to shift that to a food from the sea company. And that creates all kinds of new opportunities for us, just that shift in thinking about what we are. And I think that that's really, to me, where the excitement around ESG is as a stimulus for us to reimagine not only what we're doing, what we might do, but who we might be.
Sorry, thank you. Yes, and so just to invite Peter, do you have any final thoughts?
Yes, basically, I completely echo Dr. Ehrhart's key points on those horizons. And in this context, I would frame it more in from a Caribbean standpoint, that you've got a window of opportunity now that we've touched upon in previous discussions, where you have certain trust and respect amongst large institutions, for example, the Cayman success story, and other jurisdictions. You've got a small market, and you have an opportunity here now. If you immerse in this sustainability, social impact, and ESG area, and are really right up there from an intellectual and a practitioner standpoint, that this is really the next new wave where there is a real economy. It's not a market-made economy by investment managers, or like you have in the investment world, you have the trading culture where they can trade at a microsecond. This is a real economy, values-driven, heart-centered, focused area from the ultra-high net worth institutions, but also the new voting community of the masses that do think this way. So in this case, obviously coupling it with these principles, your expertise in governance, in bringing these high-powered people together, the phenomenon of the virtual global citizen, and of course digital transformation. You need to look at countries such as say Singapore, for example, who formed major competitive advantages in their own aspect to serve a global community, and became leaders in certain areas. And you've got an option. Do you wish to essentially sell the picks and the shovels and service this market for larger centers, or where do you wish to be a market leader in a certain niche you feel you're best able to serve? And I think an extraordinary framework. Certainly honored to be part of this panel, and thank Dr. Ehrhart and the CCGI for the participation in this discussion. Thank you.
Thank you too. And Antonia, final thoughts?
I think I'd just like to encourage that if you are in looking to see how do you embed ESG as a strategy, as a meaningful part of your business, to just recall, it's everybody in an ecosystem working towards developing emergent strategies. You have all public interests, private interests, and personal interests working together. Boards need to be looking at how their business model affects the society, affects the environment, and use their power within their governance to really seek not license to operate, as I said, but license to innovate. Whether it is you encourage an environment and enable an environment within the organization to really find those creative ideas that can have a positive impact, or you are redirecting your social spend in a way that fund projects that solve problems that affect you. We can't fix rising tides, but we certainly can build walls or move infrastructure away from the shoreline. It's where you put the money, literally. And so I'll just close with that.
Thank you so much. And so Kamla, I'm now going to turn back over to you. Thank you again to our panelists and for everybody who has joined us in the session this afternoon.